Hi everyone. So good news in the market that stocks like Bajaj Finance have run up in a single day by approximately 6%. SBI Cards, which was one of my picks, it had gone up by 40% in the last 6 months. Similarly, banks, which was again a big part of my portfolio, has again gone up substantially. Now I am cutting positions on many of these stocks, and on this video I am going to help you understand three critical things. Number one, that why these stocks are running up. The reason or the simple answer there is that there is expected increase in liquidity. So recently you would have heard that RBI has announced some policy decisions, and I'll take you through those. Second key thing is that after this RBI announcement, what are some of the key areas, stocks that you could consider aggregating, not aggregating? And finally, is it like a good time to buy stocks or should you lighten your portfolio? So these are three critical topics that I will discuss. And very quick announcement that I have a upcoming stock market batch coming. In case you guys are interested, you can sign up for that. There is just a handful of seats left. It's a 2-weekend course where you will learn everything, right from valuation, how to analyze a stock, how to analyze American stocks, Indian stocks. I'll teach you like a lot of things there. And this is a industry practitioner's viewpoint. Take a look at my US stock market portfolio. It is beating the benchmark by a lot. So it's approximately 17% higher or alpha on the benchmark. This is very good performance in the US stock market. I had announced that I'll be building such a portfolio in January. So this portfolio is doing well. And again, take a look at this portfolio. This was my Indian mutual fund portfolio, which again beats majority of the mutual funds. So again, if you're a viewer, you would know that I have been creating all these different types of portfolio. I do review the performance of those. So if you want to learn all these things fundamentally, definitely do consider checking out my next batch on the stock market. So without further ado, let me just first and foremost take you through the key policy changes that RBI has announced and how it's impacting the stock market. So I'll quickly explain you the basics. If you're only interested in understanding which stocks am I going to talk about, then skip to the second half of the video. Okay, so let's quickly jump in. There are 6 policy changes that RBI has made, and it is going to have key impact on the stock market. The first most important decision that RBI has taken is that they have cut something called as the repo rate by 50 basis point. The expectation was that, okay, RBI is going to cut the repo rate, but not so fast, but they have cut the repo rate really fast. Now, what is the meaning of repo rate? Let me just quickly help you understand it. So we have RBI, which is the Central Bank of India. Basically, it loans out or gives money to commercial banks. For example, HDFC Bank, Axis Bank, all these are commercial banks, right? And these banks further loan out to people like you or me, right? So you'll be taking home loans, car loans, all these different types of loans, business loans. So this is us. These are the eventual customers. Whom do we go to? We go to commercial banks. And where do commercial banks get their money from in a way? Well, from RBI, okay? So they are also borrowing. This HDFC Access, they borrow money from RBI. Now RBI, while lending it to these commercial banks, they will follow a particular rate of interest. Let's say that this rate of interest was 3.5%, right? Now they have cut it by 50 basis points. So they have brought this down by a certain percentage. So as a result, what should ideally happen? Well, in the next chain, the commercial banks should also cut loans for us. So this is the key primary change that has happened. And this is the meaning of repo rate, that repo rate is the rate at which RBI lends to the other set of banks, right? So I'm explaining you very simple definition here. So I hope that this is clear. And therefore people are saying that, hey, now what is going to happen is that your housing loans or the EMIs that you pay, that is going to come down. If you have a 50 lakh rupee loan, now calculations tell us that your monthly EMI will fall by 1500 rupees. So this is what the mathematics tells us, assuming that you are doing new borrowing and it is not like, previous borrowing that you have done. So this is the point here. The second key change that RBI has done is to change the cash reserve ratio. Now cash reserve ratio means what? Well, so let's say that HDFC Bank, basically when it gets 100 rupees from RBI, what they have to do is that they have to do 2 things. One is that first they will loan out some bit of money to people like you and me, right? So let's say that HDFC can only loan out 80 rupees. And 20 rupees, what do they do with this part B? Well, they have to reserve it as a cash. Okay. This is called as cash reserve ratio of 20%, right? Now, why this 20% is required? Well, because some people are making deposits. For example, you might be depositing an FD with HDFC. You might be having a savings account with HDFC and you might require money immediately, right? You might go tomorrow and you will say that, you know what? I had done a 5 crore FD with you, give me this money back. So the bank keeps a certain bit of money or certain reserves with them, which are called as cash reserves, for servicing these type of requests. And the RBI mandates that what that CRR or cash reserve ratio should be. So basically what RBI has done now is that they have cut this cash reserve ratio by 3% in a phased manner. Now, as a result, what will happen? Well, simple key change for an investor that you should know is that in this respect, basically now HDFC will have more money to lend out further. Okay, so this is the key change that has happened here. Now, some other changes have also been made which are slightly more qualitative in nature. For example, a policy stance has been shifted to neutral. Now, what does this mean? Now, earlier they were hawkish. Hawkish means that they were worried that, you know what, inflation will go up in the economy, so we will not bring in liquidity. Okay, what is the meaning of bringing liquidity? See, the first two steps that RBI has taken, what it will do? Well, it will move more money from banks to you. So there is more money coming into the economy, right? People are going to take more loans. Why? Because cheaper loans, all that stuff. So this is called as increase in liquidity. Now, in simple terms, what it means is this, that for example, let's say that if 10 units of money was flowing in the India's economy, right now, 11 units of money will start flowing in India's economy. Now, this has probably the most significant impact on the stock market. There is a very good quote that I keep on using, that liquidity creates fundamentals. Fundamentals do not create liquidity. Now, what is the meaning of this? Well, okay, very simple words. See, if generally people have more money in their hands, they are going to go and spend it, or they are going to do something with it, invest it, or they are going to build a new business, hire more people. So that is this process of increased money supply in the economy is called as increasing liquidity. Now you'll say that, okay, this sounds so simple. Then why is it that government does not keep doing it only? Well, because it has its separate cost. The cost is that if you increase liquidity in the market, then inflation goes up. Inflation means that generally price increase happens in things. Now again, think about it. For example, if people have crazy amount of money because of increased liquidity, what will they do? They'll go and buy houses, or they will go and buy vegetables, or they'll go and buy whatever, like, cookers. Now, as a result, because there is sudden spike in demand for all these items, what will the sellers do? They will raise the prices for everything. So this has happened in 2020 also, when 2021 rather, and I'll show you some liquidity phases, but this is the meaning of liquidity. So, okay, so coming back to what RBI is doing. So they have shifted their stance to neutral. Now, why have they shifted their stance to neutral? Because they feel that, okay, inflation is somewhat in control. Then inflation outlook, RBI is saying that, hey, you know what, we are going to have low inflation. GDP growth, they are saying that, hey, we will hit 6.5. Is this a great number? No. Okay. Now here is a complete discussion that I have done on GDP. In case you guys are interested, you can go and watch this video. You will learn a lot of new things. Then final point, gold loan to LTV. Now this has been raised to 85. Now what it simply means is that, see, if you have gold, you can go and previously, let's say that you used to deposit like 100 rupees of gold with Manappuram Finance or whatever. Okay. Then they used to give you, let's say, 85 rupees worth of gold. Okay. Now RBI is saying that, hey, 85 nahi karo, right? Do it like 90, something like this. Okay. So this is increase in LTV. So these are some key changes that has happened. And as a result, what has happened is there are a few types of stocks that have benefited. For example, banking stocks have benefited. You would have seen that HDFC, Kotak, all these little increase has happened. And in fact, in the last 6 months, these stocks have been doing really well. Similarly, SBI cards has run up like crazy, right? This was one of my core stocks, right? I have been speaking very positively about it. Then you have Aavas Finances, which has also gone up. You had Muthoot Finance that has gone up. You have wealth management companies that have gone up. So generally finance stocks have done well. And if you remember, please go and watch some of my old videos. I had been categorically saying that I'm finance heavy. Almost 70-80% of my portfolio, Indian portfolio, is finance. Now what I will be doing going forward is that I'll be cutting this portfolio. Now it's not as if that I'll sell the entire thing, but I'll cut a lot of this portfolio, move it to other sectors, which I will talk about it subsequently. Now comes point number 2, that, okay, RBI has made all these amazing moves. And what does this mean for the stock market? So as I said earlier, that liquidity creates fundamentals. Fundamentals do not create liquidity. Now, what is the meaning of this? So let me explain it to you by picking a real example. Now, one stock on my portfolio which hasn't done really well is HUL. It's not as if that I'm at a loss, because I keep on buying, adding little bit of it whenever the opportunity comes. But let me explain you this fundamental and liquidity wala point via this. See, one of the key reasons why HUL stock is suffering is because of something called as consumer demand. Now, basically, if you read the HUL's management statements, they will say that, you know what, the consumer demand in India is weak. The savings rate in India is not going up, especially in the middle class segment. So as a result, what is happening is that, for example, the volume increase. If you go and study this tab, this 63,000 crore, it's not as if that HUL is not making revenues. Well, its revenues are growing up and its profits are also going up. But the problem that is happening in HUL case is that this entire increase in revenue, because what is revenue? Revenues is price times quantity. Let's say 100 shampoo bottles HUL sells, and let's say that they sell this 100 shampoo bottles at 500 rupees. So what is the total revenue? It's 50000. So this is 50,000. Okay. Why? Because this is price times the quantity. So 100 shampoo bottles is the quantity and 500 is the price point. Okay. So revenue is made from this. What HUL has been saying for the last 1.5, 2 years now is that, see boss, price we are able to increase by 10-11% every year. But the quantity or volume growth is not happening in the Indian market. Now, HUL is not the only company. In fact, if you look at any consumer durable stock, all the stocks have been doing badly, be it Asian Paints, majority of them, right? I mean, they have suffered. For example, in the 2021-2022 phase, there was Whirlpool, Voltas, all these companies were suffering quite a lot. Why? Because they had a lot of pent up inventory. And basically the issue was in the Indian economy that was happening is that this quantity increase was not happening. There was no volume growth that was happening. So RBI through these steps, what is it that it is trying to do? Well, it is trying to increase the volume in the Indian economy, or in simple terms, it is trying to increase the consumer sentiment. It is trying to push that up. Why? Because honestly, wage growth hasn't happened in the Indian market for the last at least 3 years, right? And this is really hurting consumption. On top of that, what is happening right now is that there are recessionary concerns that are coming up. If you watch my last video, I had categorically said that people like Elon Musk are categorically saying now that, you know what, by 2025 end, we will hit a recession, or 2026 mid-half, we will hit a recession. Why? Because due to Donald Trump's trade war policies, there has been issues. There is uncertainty in the market. Now, on top of that, we have like consumer sentiment, which is low. Now, on top of that, if the world economy is slowing down, on top of that, there are 100 different trade war related issues due to which companies are not expanding their capacity. All this will reflect in what? Well, this will lead to a slowdown in GDP. And that is what the meaning of recession is. So almost every country right now, and I'll give you 2-3 examples. One, India, our central bank has cut the lending rate. They have done what? They have increased liquidity or has brought in more money into the economy. Similarly, US, there is something called as one big beautiful bill in the US. Now, what is it doing? Well, it is increasing debt on their economy. Now, when they increase more debt, the government is going to pick that money and throw it again in the US economy. So what is that going to do? Well, it is going to bring more dollars into the economy. What is China and Europe doing? Well, they are again doing a variant of quantitative easing, which simply means that they are going to create more liquidity. Why? Because the central argument that I explained you, right, is that they are all worried about a GDP growth as of now. And just to prevent the economies from not going into a recession after 6 to 12 months, they have taken this preemptive move. Inflation might go up, we don't care, but we have to increase liquidity right now. So this is a complicated macro topic. This takes like, 3 semesters to teach at a business school what I've taught you in the last 10-15 minutes. Hopefully you are able to understand and grasp what is going on. So then comes a natural question that if the liquidity goes up in the Indian economy, in the US economy, in the Chinese, European economy, then how does it impact the stock market? Well, the answer depends on which country's stock market you're looking at. So we'll relate our discussion only to US and Indian stock market, and primarily Indian stock market. See, Indian stock market and US stock market has a very strong correlation. I understand some wealth manager have started peddling the thing that US and India has no correlation. I've shown you earlier. Go and compare NASDAQ chart, how it shapes up, and Nifty 50 chart. You will see very strong correlation between the two. Anyways, coming back to the point that generally speaking, liquidity is good for stock markets both in India and the US. Now, there are different phases that you can study, and let me take you through 3 most recent phases where liquidity increase has happened on Indian stock market and US stock market and how it has impacted exact stocks, right? So let me just quickly show you this tab. Okay, so here are last 3 phases when there was an aggressive money supply increase. This is what is happening with the RBI moves also. That first and foremost, this took place in 2020 and 2021, right? You would have remembered that, okay, the market had dipped like this. And again, I'll ask my editor to put the chart here, right? That the markets went from 12,500 Nifty to roughly 8,500, right? In this phase. Then suddenly a lot of liquidity was brought at this point. And as a result, the market went up to 18,000 after that liquidity rally. Now this was very big. This lasted somewhere around till like 2022. Then there was no improvement in liquidity. The liquidity was kept sideways. Now, as a result, there was a correction in 2022 and a lot of small caps, mid caps in India corrected quite aggressively. Then there was another liquidity rally, not as extensive here, but here, this was another massive liquidity rally that had happened. And since then, the markets have gone from 18K to almost 25K. This is where we are. Now we are sitting in 2025 wondering that, you know what, okay, another round of liquidity. So will the markets go from 25 to 30K? Okay. Now, I don't think that this is going to happen. And I'll just quickly give you my perspective on this. Why? See, what has happened is that when we moved from this 8,500 to 18K, the valuations on the market, be it NASDAQ, be it Nifty 50, was very cheap. Okay. This was very, very cheap, right? So this kind of liquidity kind of made sense, right? Then between like 18 and there was a consolidation period, right? I mean, there was some correction that had happened in the year 2022 to 2023. And then after that, market did another round of good rally here. Okay. So here, this was the valuation correction that had happened in this phase, right? So between like 2022 to 2023. Now then 2023 to 2025, there was another run up, this run up, right? And this has happened again due to increase in liquidity. But here we would say that the valuations were fair, right? And then they became overstretched. Now we are in a zone in 2025 where the market valuations are already stretched. So therefore, I don't see this giving like exceptional returns. Now, this does not mean that the markets will not go up by 10, 12%, something like this. It will. Okay. So that might happen, but I don't expect like a 40% rally, 30% rally, something of that sort in a very quick span of time. So for example, if you consider 25 to 30, so that is 1/5. So that is 20%. Now for this rally to sustain, like from 25 to 30, the market should at least go to like 33,000. Why? Because there has to be a 10% gap between these two things for it to be a sustainable rally. Because what you would have seen is that the market goes up like this, right? Then it falls back to this support, right? So I'm talking about a sustained rally. So this is unlikely to happen, that we are not going to decisively hit this 30,000 mark. For this to hit 30,000 mark, we have to go to 33 at least, right? And this is unlikely to happen in the next 1 to 2 years. The simple reason for that is that we are already in an overheated zone. So this is the reason why many people, what they simply do is that they will look at that, okay, in the last 3 rallies, when liquidity had increased, the market had went up like crazy. So this time also it will go up like crazy. Well, no, it's unlikely that that will happen. But having said this, we as investors always need to keep our mind open, right? It can, my hypothesis can be wrong. And whenever I figure out that, okay, you know what, probably I have to revise my hypothesis, I will revise my hypothesis. But as of today, we have to work with the assumption that there is overvaluation in the market. Now, then comes the final section that, okay, how should you behave as an investor and what are some of the stocks that you should think about investing in this type of a market? See, first and foremost, you must do it or make like market level information, right? So for example, here, if you take a look at Nifty 50 on a monthly candle, what you will notice is that it is trading on its long-term support. Okay. So this rally from here to here, from this point to this point is doable, this 10-11% gain. So this puts the Nifty 50 to which point, right? From 25K, it puts the Nifty to 27.5 flimsy rally. Okay, now what is the meaning of flimsy? Flimsy means कि इसके ऊपर it has to go and sustain, right? So that is when we will say that this 27.5 has been decisively achieved. So this 10-11% gain, you should be able to pocket. So right now, my portfolio split on Indian market is roughly 50%, 60% I'm invested, 40% I'm on cash. So now this 40%, or I would go like 90-10, right, in the Indian market, or maybe 80-20 for now. I'll go in the Indian market. And now, natural question, some of you would say, hey, Akshat, you missed the rally. No, nothing like that. See guys, I mean, as I explained earlier, that almost 70-80% of my portfolio was on finance. Now I have been cutting my finance portfolio, and therefore these are like very fresh sells. Around what pivot point? 25,000. So I would have sold it at maybe like 24,300, 400, something like this. Okay. So it's not as if that I've taken like a massive hit or something like that, right? So now I will go like 80-20 on Indian market. So in the US, I will do like 80-20, right? So this is already constructed for me. India, what I have to do now is that I have to move from finance stocks, which are getting a little bit bloated now, to non-finance stocks, right? So this is a portfolio change that I'm making around this pivot point of 24,500, 25,000, right? Little bit here and there can always, like, 400-500 points and all this stuff you can never capture, right? As an investor, that's always up for debate. But long story short, right now, unless this thing is completely hit, right? This technical resistance is completely hit, I would kind of go like 80-20, right? And stay put, right? At this point, because this trading can happen in this channel, right? Now, when will the breakout happen? Because that's a good, interesting discussion that, okay, why are you saying that, hey, we will hit this and then, likely to trade like this? Because see, one of the key signs of a breakout, and you can make a note of this, is that when there is overvaluation everywhere. For example, when you can decisively say that consumer durable stocks are definitely overvalued, finance are definitely overvalued, you have like energy stocks which are definitely overvalued. So you will see this general, right, euphoria everywhere. So we are not in that euphoric zone. Therefore, we cannot say that, this we will definitely break. But till this point, I would rather I would go and invest like another 20-30% of my portfolio quickly now, right? Just to rotate this. This is a trading portfolio of 30%. Now let me give you some examples. And this is not a stock recommendation, guys. So for example, if you take a look at something like Hero MotoCorp, right? So Hero MotoCorp from its top is still trading down 31% from its peak. Okay. So this looks like reasonable, right? Given the fact that the company's revenues have also gone really fast. So for example, here you can see, so if you take a look at company's revenues and profits, so it's not as if that the company is struggling, right? The company has been able to grow at a decent pace. Its EPS is expanding. So this is like a solid stock from that angle, right? I mean, even from a technicals point of view. What about like some other example? For example, let me show you IEX. Now this was a darling of a stock, right? In fact, I picked it up like last month, right? So this is where like I've given enough commentaries on my YouTube member community, etc. And basically here is where I picked it up, right? Somewhere here, right? And since then it has already gone up like 15%, something like this from my buy price. And this is like my technical selling price, right? So this is the price point at which it should technically get sold, approximately like 316, 317. This is what a long-term investor's viewpoint would be. Now then comes a natural question that, okay, what about your view on HDFC Bank? You are like such a bullish person on HDFC Bank. Suddenly you have stopped talking about HDFC Bank, because HDFC Bank is now in a selling zone for me. It's not as if that as an investor, you put money and you are forever holding and buying a stock, nothing like this. If technicals tell you to sell, you sell, right? So here is where HDFC Bank is. This was a trading channel for HDFC Bank. It has already hit this mark. So I'm okay exiting some of my positions. Okay. Now please note, let's say that I started investing in an HDFC Bank. I am not exiting completely. I will sell maybe like 60% of my positions. Okay. Now comes that, let's say that I had like invested 2 crores. Okay. And I grew that money to 3 crores. Now I have 1 crore of profits. Okay. Now, out of this 3 crores, I'm selling 60%, right? So approximately I'm selling 1.8 crores. Now, kitne bache? 1.2 crores, right? Now, this 1.8 crores that I've sold, it's not as if that I'm not rotating this to somewhere else. I might be buying something like IEX. I might be buying something like Hero MotoCorp. These type of companies I might be buying, right? So people, what they will start doing from tomorrow is that if HDFC Bank gives like a 5% run up, oh, Akshat, you missed out on like HDFC Bank rally. No, sir, I already captured like 30% profits overall on my portfolio on HDFC Bank. Was it the best trade that I took? No, not at all, right? I mean, it was a slow moving growth. Unfortunately, it did not play out the way I wanted it to play out, but it's not as if that I have made some losses on it or I did not grow faster than Nifty 50. I've still beaten the benchmark, right? On a bulk bet on HDFC Bank. Okay. So long story short, so if you take a look at majority of the banks, they are hitting that resistance point. It kind of makes sense to book some profits because there is a good chance that some of this capital might be rotated. It might give you another 5%. I don't know, but there is a chance that some of this capital might get rotated to other stocks. So for one category of stocks that I'm bullish on is consumer durables, because the cycle had been really bad. Now the cycle might turn. Now this does not mean that you go and buy HUL tomorrow. Okay, so you have to do like technical analysis, right? And then accordingly do it. Number 2, auto stocks look fine as of today, right? They are not hyper overvalued. There are some exchanges. For example, NSE, I had picked up in the unlisted market. Now there is a lot of interest in NSE. So NSE was a very good stock. I'll have to go redo the valuation analysis again on NSE, but again, overall very good company. Swiggy has run up very, very recently. So I picked it up 360 in unlisted. Now it has gone up more than that. And hopefully it will continue to do well. I want to pick some tech stocks in India, but unfortunately I'm not finding like anything outside like traditional tech players. So I'm struggling a little bit. I am also running my analysis and I'll see whether it makes sense to buy tech in India or not. But in the US, there are exceptionally good opportunities in tech, which I'm still buying, very high growth companies. Then you have banks. Now the issue with banks is that with the recent changes, their margins are going to go down. And whenever margin distortion happens, usually the stocks correct, right? Now, I'm not saying that this will happen in the next 3-4 months, 5 months, because loan book will expand and then, margin contraction will happen. So let's wait and see how that plays out. But I don't want want to be sitting on too much risk. When it comes to NBFCs, that's a better bet. Still, I'm not exiting too much of my NBFC stocks. For example, Avas is there. You have Aptus Value Financing. I might be adding a company called as Canfin, right? So all these companies are there, right, which I'm looking at, and I'll see how to restructure a portfolio there. But these are some inclinations, directions in which I'll reconstruct my portfolio. The most important message that I'll give you, and 3-4 key takeaways that I'll leave you with, is that number one, please do not get married to a theme. Okay, so just because you have too much finance stock, it does not make finance stocks great. Finance stocks have given a run up, beat CAM, CDSL, Motilal Oswal, HDFC AMC, all these companies, even HDFC Bank and all that have given very good run up. Time to book some profits. This is what I'll leave you with. If you don't want to book like 30-40%, fine, don't book so much. Book like a little bit less, rotate it somewhere else. Number two, do not be bearish, do not be hyper bullish, right, about the markets, because there are still pockets of undervalued opportunities. Valuations are still rich. It is still going to be a sideways market, as I have been saying. There is no clear indication why we would hit above 30,000 levels. So don't be euphoric. Keep 20% on the side as cash. Okay, what that allows you to do is that allows you to buy things really cheap whenever things go cheap. Don't unnecessarily keep on doing SIPs. Okay, so study a little bit of valuations. And again, if you feel that my course can help, definitely do check the links in the description comments. Final point is that these are macro changes that are happening. The world will continue to chase growth. Don't stay away from the stock market for too long, right? There are a lot of mutual funds who are keeping cash. I agree with their strategy. In fact, I have also been doing the same for the last 2-3 months. But now, because of the clarity on interest rates, we need to start looking at the fact where we can deploy capital, at least not in overvalued stocks. So that's the message I'll leave you with. I hope you enjoyed this conversation, and I'll see you soon.